Ladies and gentlemen, good day and welcome to the H2 FY25 earnings conference call of Neers Tools Limited, hosted by Share India Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harsh Patel from Share India Securities. Thank you, and over to you, sir.
Thank you, and good afternoon, everyone. Congratulations. I'd like to congratulate the management on a very good set of numbers. On behalf of Share India Securities, I welcome you all to H2 FY25 earnings conference call of Neers Tools. We are pleased to have with us the management team represented by Mr. Neeraj Kumar Agarwal, Managing Director, Dr. Kanav Gupta, CFO and the Whole-Time Director. We will have the opening remarks from the management, followed by question and answer session. Thank you, and over to you, sir.
Good afternoon, esteemed investors, analysts, and valued shareholders. I am Kanav Gupta, CFO and Whole-Time Director of Neers Tools Limited. Before I delve into our FY25 performance, let me share the rich legacy that forms the foundation of our company. Our promoter's family journey in the hand tool industry began over 7 decades ago in 1952, starting with a modest setup in Delhi. This 70-plus years of accumulated expertise and deep industry knowledge has been the cornerstone of our success. Building on this legacy, in 2018, along with our MD, Mr. Neeraj Agarwal, we established Neers Tools with a vision to create a premium Indian brand that would revolutionize the hand tool industry in India. Today, Neers stands as India's third largest hand tool supplier, offering an industry-leading portfolio of over 5,000 SKUs, the most comprehensive range in the Indian market. Serve over 10 diverse industries, including automotive, infrastructure, healthcare, and manufacturing sectors through a robust network of 300 plus active dealers across more than 2,700 cities pan-India. I am delighted to report that FY25 has been a landmark year for Neers, backed with exceptional performance. We achieved 145 crores in revenue, representing a robust 32% year-on-year growth, demonstrating strong market demand and execution excellence. Our EBITDA nearly doubled to 27.71 crores, marking an impressive 89% year-on-year growth, while PAT more than doubled to 17.63 crores, a remarkable 104% year-on-year increase. We delivered substantial margin improvements across all metrics. Gross margin expanded by 352 basis points to 28.28%. EBITDA margins improved by 574 basis points to 19.12%. PAT margins enhanced by 428 basis points to 12.17%. Our ROE reached an impressive 20.91%, reflecting efficient capital deployment and strong shareholder value creation. Our performance is underpinned by several strategic initiatives. We've established Neers Tools Trading LLC in Dubai with a 900 square feet experience center and a 15,000 square feet warehouse, positioning us as the first Indian hand tool brand with dedicated infrastructure in the Middle East. We've already commenced operations with 2 or 3 dealers in UAE. On our OEM partnerships have grown from 3 OEMs to 12 in just 1 year. We've recently secured brand approvals from automotive giants like Maruti Suzuki and Hyundai for specialized EV insulated tools, positioning us strategically in India's high-growth electric vehicle ecosystem. We are also planning to become India's first manufacturer of Germany-based VDE certified insulated tools, capitalizing on India's EV revolution and import substitution opportunities. We've optimized our working capital cycle, reducing our inventory days from 327 to 231, demonstrating improved operational efficiency. Looking ahead, we've started an ambitious growth trajectory. We are expecting revenue and profitability CAGR increase of minimum 25% plus. International revenue contribution out of this should be more than 15% from our UAE subsidiary. ROE target of more than 25%. Working capital cycle optimization to below 3 months. Neers represents a compelling business opportunity in the 10,000 crore Indian hand tool market. As the organized sector gains market share from unorganized players, we are uniquely positioned with our comprehensive product range, strong brand equity, and strategic expansion initiatives. In nutshell, our FY25 performance demonstrates that Neers is not just maintaining its market position, but actively expanding its footprint both domestically and internationally. With our robust financial metrics, strategic initiatives, and clear vision of the future, we are confident in delivering sustained value to all our stakeholders. Thank you for continued trust and support. I now welcome your questions.
Thank you
Over
very
to
much.
you.
We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, you may press star and one to ask a question. Our first question comes from the line of Sasha Porwal, who's an investor. Please go ahead.
Hello.
Yes, ma'am. Please go ahead with your question.
Hello. Congratulations on the result. This is one question that I had was, what's the status of the Dubai operations?
So yes, our Dubai operations have commenced. In this year also we have consolidated results for both UAE and India. The warehouse and the showroom has been set up well, and the operations have started. We have made approximately 2 to 3 dealers. The idea is to start and operate in the same way we are doing here in Delhi, India. So we are centrally placed here in Delhi, and we are distributing to active dealers all over India. Similarly, in UAE, setting up the showroom and the warehouse at a central location, which is Dubai, and from there we hope to cater the whole of UAE first and then move on to the GCC belt.
Okay. So it's almost done and you're going to start soon.
Yes.
Thank you. Thank you so much.
Thank you. Ladies and gentlemen, you may press star and one to ask a question. A reminder to all participants, you may press star and one to ask a question. Our next question comes from the line of Viral Jain, who's an investor. Please go ahead.
Yeah. Hello. Am I
Yes,
audible?
sir. Please go ahead. Yes, sir.
Yeah. Congratulations for a good set of numbers. I had a question for that we have secured OEM approval from Maruti and Hyundai. So what is the expected ramp-up timeline and your contribution to the revenue in upcoming year? And another question was related to inventory. that you are saying that you will be reducing it to 3 months. So what steps you will be taking to improve this?
Okay, so I'll answer one by one. The Maruti and Hyundai operations and the sales have already started. Brand Neers has been approved through another OEM. So the sales and the insulated EV kits which we are making for Maruti as well as Hyundai, we have supplied almost more than 600 kits to Maruti already. It is tough to answer how much percentage of the total it will be, but I expect in the coming year, Maruti will alone contribute to 4% or more to my total sales.
Okay.
Secondly, for the inventory part, for this you need to understand the business. We have more than 5,000 SKU, which is the industry leading SKU size. So for this, we have to keep a minimum order quantity MOQ of all the products. For that, stock is like my capex. I have to keep a limit, MOQ of each and every item which I put in my price list, right? So for that, my absolute number, whether it is around 85 to 100 crores, it shall remain the same, or it shall increase by negligible percentage, 2 to 5%. But my sales, which we expect to grow by 25 to 30%, so that is how we will make the stock cycle efficient. Our sale will increase in a proportion of 25 to 30% minimum every year, and the stock increase will be negligible, like 2 to 5% or same every year. This will keep on increasing the efficiency of inventories to sales every year. Thank you.
Okay. I had another question regarding your vision of 2030 that your revenue would be 50% revenue would be from exports. So where do we currently stand, and which are the geographies which are more promising to you?
So according to my 2030 vision, 15%, 15 of the total revenue I expect to be of exports. This would majorly include my Dubai subsidiary, as I think Dubai or UAE is as big a market as India, so I would believe that I do the same sales in UAE which I am doing as of today in India in the next 5 years. So yes, majorly will come from UAE and GCC, but last year we put up an exhibition in Cologne, Messi, which is the biggest hand tool exhibition in the world. So we are also trying to eye towards the European market, but that is not our main aim as of now. The major of this contribution I expect to come from UAE and then Europe.
So how was the initial response from Dubai side?
The initial response is obviously very good. We, along with the team, visited the markets quite a few times in the past 2 years, and we took feedbacks for our products, the price we are selling at, and the prices which we can get, the margins, the expandability of the region. So everything was very, very positive, which enabled us to move towards taking this step and set up our office in Dubai.
Okay, thank you.
Thank you. Our next question comes from the line of Keshav Kumar from Raksan Investors. Please go ahead.
Hi, sir. I'm new to the company and I'm ill prepared to ask very relevant questions this time around, but would first want to get some clarity on whether the current margins are sustainable.
Yes. So answering to this, we are in a brand game. We are selling a commodity. And as you have seen in the last 3 or 4 years, the trajectory of our results, you will see when the brand comes at play, the margin keeps on improving. I am very sure the margin and will increase by a few base points every year, and at least it will be sustained as when we become a brand and when we become stronger in the market, we are able to command higher prices or better prices for the same branded product that we are selling. So they are definitely sustainable.
Sure, sir. And sir, for the full year, were there any inventory write-offs, if you could give a number, and if you could also help understand for our kind of a business where inventories are CapEx, what is the expected value for the same?
I would like Mr. Vijay to answer on this, please.
Hi, audible?
Yes.
Hello.
Yes,
Yeah, please go
audible.
on.
Yes, sir. Please
Yes.
go ahead, sir.
So, regarding inventory write-off, so in there have no such instance where we have encountered any sort of inventory write-off. So, not much to add upon over here. And regarding your second query, I would request you to, if you can just please repeat that once again.
No, I was just, I wanted to get some clarity, because in our kind of a business model where we have very limited CapEx and we have to basically populate inventory, and that forms our CapEx basket. So how much do we tend to incur as inventory write-off on an ongoing basis?
No, so I would still keep my comment, I mean, as the earlier one. So we have not made any sort of inventory write-off, and that will not happen going forward as well. If I just give you a bit more insight about how our inventory works. So like Mr. Kanak Gupta also explained, given the business nature of ours, because we have to maintain a certain quantum of inventory currently, this is a sort of, I would say, an entry barrier where we have incurred as of now 90 to 100 CR of inventory already. And we believe going forward, this level of inventory will help us sustain larger volumes of sales as well. And by this we can say that it is capable of catering to 2 to 3x of our top line with a minimal increase in our inventory. And coming to the write-off point once again, so given the sort of brand we our inventory is also a sort of an appreciable asset, to be put that way, because every year we have our strategic policy for increasing our price list, because I mean, in our business, once we have our finished products available with us, we keep on increasing our prices. We have been doing so in a couple of years as well. So that is something where we have our inventory in place that naturally appreciates once we increase our price list as well. So this is something which has not been an issue. And adding to this point, typically what we see is that most of the steel product manufacturers, they actually link their inventory with the direct market price of steel as well. But if you try to correlate that with the steel cycle, so I would add like since 2022, there has been a downtrend in our steel prices. I mean, from 60 per kg, it has corrected to somewhere 40 per kg. But during that time also, that our inventory was stable, oscillating around the 90 CR to 95 CR level. And during that point, during that duration in the past 2 to 3 years, our margins have actually improved by 200 or 250 basis points. So given we being a brand player, this is something which has concern for us.
Let me just add to Sir Vijay. I'm Neeraj Agrawal this side. The main what you want to know, I would like to clarify it. See, we are into the hand tool business from more than 70 years. We know each and every small to small point of the item what we are trading in. And you would be happy to hear that not even 1% of the total stocks that we are holding is not there, which is actually not moving during the year. Nothing like that. Because when we enter into a new product, we introduce any new SKU, we definitely go into very deep study about the same for the market. And if there is any the demand in the market, we definitely sell it off with some 2 to 5% or 10% additional discount to the dealer. And definitely on the items which are slow moving, we add upon a more 100% profit so that we can always earn if we keep a stock for more than 4 to 6 months for that particular item. So I don't think so that anytime in future we will require any money to write it off, as that has not happened in the past 70 years with us.
Thanks a lot for the clarity, sir. Just one more question on the growth target we have, which is 25 to 30%, as you said. So is there something fundamentally changing because we have grown very well in the last year, but before that we did not grow by that quantum. So is there something fundamentally changing in the industry that we are in, where we can expect a more secular 25 to 30% growth going forward?
I'll answer to this, Kanav here. See, we created this brand in 2018. And play is like, once you tell the customers that this brand is there, they use it, then they come back for it. So it is a time-taking process, but once the customer is joined up with you, they are with you forever. That is the beauty of making a brand. So now, with the existing legacy dealer network, we can easily say that 25 to 30% is the sustainable CAGR growth we will see in the future. Earlier, we were having less dealers. Our sale comes from the dealer and distributor network, legacy-wise, which comes OEM or UAE business. This we have added lately. So, basis on that, we can commit that yes, this is the kind of sales trajectory that we can see in the future.
Yes, sir, just one clarity on that. So in the brand building, is the debtor days reduction a symptom of us getting stronger in that? And should that sustain? Because our debtors have stayed, I mean, in absolute numbers, receivables have stayed the same year on year, and our debtor days have gone down substantially.
Our debtor days have gone down substantially. They have, if we are increasing the sale by 35% this year, and the debtor days are same in absolute number. That means in percentage, the debtor days already become more efficient. So
no, that is exactly what I mean, sir. So is it something that is structurally going to pan out going forward as well?
Yes, 100%. Once see how any new player sells their goods. First, we voluntarily keep our debtor days to be higher, the credit period to be higher, so that the customer feels that yes, he is more comfortable in buying from Neers than any of the competitors. There are many big brands, 70-year-old, 50-year-old, then even us who were in the market. As a brand, when we went to penetrate, in India at least, credit is the first thing which eases the customer. So we planned out that way, but now when the brand becomes stronger and the brand comes into play, we can definitely reduce their credit cycle, and they also accept that yes, now the terms have been regular and the credit cycle has been reduced, and they also accept that. All major brand players in any industry have done that. They start from a bigger credit cycle and then they reduce it. Similarly, will happen for us.
Great, sir. Thanks a lot for all the clarity. I'll come back in the queue, and all the best.
Thank you.
Thank you. Our next question comes from the line of Rohit Priyadarshi with MAL. Please go ahead.
Hi, sir. Thanks for the opportunity. This is Yogansh Jesani.
Sorry to interrupt you, Rohit. Your audio is not coming in very loud. Can you please use your handset?
Is it better now?
Yes, please. Go ahead. Thank you.
Yeah. I'm saying this is Yogansh, Rohit's colleague. So a couple of questions from my end. One is a follow-up on a previous participant's question on the growth. So like you mentioned that 25% kind of growth is something that we are targeting, and we've been on a brand building exercise. So could you just put in little more light on how this growth will pan out? Like you have added a couple of OEM clients. So will OEM be a bigger growth driver for us in coming few years? Because until now we didn't have any much of a OEM business. Or will it be more driven from the dealer distributor network?
So my three main growth drivers, if I name, first, our initial business, as you said, came from the dealers and distributors, right? Now, second avenue which has opened for us about last year or 2 years back, OEM segment. Third is our UAE subsidiary, which is a big growth driver for us. So I am expecting very, very good results from all three, of which I am sure dealer and distributor network for us have always compounded to a growth of about, I can put it this way, the hand tool industry in India, the dealer hand tool industry, it is increasing by 8 to 9% every annum. And we know how aggressive we are. We are all young promoters and we are penetrating deep into the Indian market. I expect I beat that by at least 2x to 3x. The basic organic growth of the industry, I will always beat that by 2x or 3x. Right? So from that legacy dealer or distributor network, I can expect 20 to 25% growth pouring in. Now, from the EV industry, like I was reading in the news that Jaguar Land Rover has announced by 2030 they will stop making petrol and diesel vehicles and only electric vehicles will be there. For that, we are pioneers in making EV tools. We are the first people who are actually going to manufacture and in that process to make that EV tool in India. So from that, we expect a very, very big new industry coming in. I cannot commit the numbers or the percentage, but I see there is a huge growth potential from there as well. Now coming to my third growth driver, UAE. I think UAE is as big a market as India as of today. I am doing approximately 145 crores of sale in India. I can easily achieve this once I penetrate in the UAE market. So again, for the UAE market, I cannot commit big numbers, but to give an idea, it is as big as India. And to penetrate into UAE, there is other Gulf countries, GCC, then the OEMs in the UAE, like the Abu Dhabi National Oil Company, they are huge. So the avenues we have opened, we can definitely achieve what I am trying to say conservatively.
Got it, sir. That was helpful. So, sir, in terms of building your distribution network, so internally, what would be our target by this year and how many new distributors are we looking to add?
I would like Mr. Neers to answer this more exactly.
See, there was one thing which I would like to add upon the earlier question of yours, and that is as we are number 3 in the hand tool industry as of now, and we have kept our prices to be at a very low price at this moment, earning that much what we are actually earning at this moment, and we are actually at a gap of say 25% to 45% from the people who are above us in the pricing. So at this moment, as our brand is getting famous and popular day by day, and the dealers and the distributors who are working with us from the past few years, they have already taken up a hike for this coming year of say about 20 to 25% in their yearly sales to be made. And not much, but I would say about 25 to 35 would be the number of distributors coming up. See, we have we make the sales through distributors as well as dealers, and as well as we make the sales from B2B, B2C, like all the sort of sales we try to cover up. But what we are talking about here is a distributor network to be created, which is the strongest and which is the best for the times to come, so that an area is given to the distributor for say 20, 40 something kilometers like that, so that area is being taken care by that particular distributor, and he can gather orders from his sub dealers, and collectively we can just handle one distributor, and over the time we try to convert the very small dealers into the big dealers and big dealers into the distribution network, and people are ready to take up distributorship in those places where there are quite a few small dealers or maybe big dealers, so that whenever they make good investment, they get a good sales as well as profit, because that is already there into our product. The profit is definitely there. So we are having a good feedback from the market.
Got it, sir. So secondly, on your working capital side, in your opening remarks, you mentioned that you have brought down inventory days to 231 from 300+ plus days. And in your presentation, you have mentioned some better automated inventory optimization tool. So could you just help us understand a bit more on this drive? Because this is a significant number on your balance sheet. How have we reduced it down by 100 odd days, and what is the next target for us?
Mr. Vijay will take this question. Yeah. Hi, let me know once I'm audible.
Yeah, you are.
Yes, you're audible.
Yes, sir, please go ahead.
Yes. Yes. So, when we talk about our inventory, so again, given quantum of inventory that we are currently maintaining, which is close to 100 CR. Now, this is something which will help us to scale 2 to 3 of our current top line. And given this fact, and this is something which has been happening in past couple of years as well, like our inventory being stable at similar levels, our top line being increasing, and this is something which has actually helped us, naturally offset our or maybe automate our to optimal levels, and that's what we call as automated inventory optimization, where once we have got all the sort of basic minimum, let's say market ready inventory infrastructure ready. Once we have that in place, with our rising sales, you will see that naturally sorry. There was some sort of disturbance. For you saying something?
Mr. Rohit, may we request to self-mute your line, sir? Thank you.
Yeah. This is exactly the reason, like, since past couple of years, where our top line has been growing with average rate of around 30 to 34%. Our inventory that has been growing at a modest rate of 5 to 10% to be precise, and in fact it was taken for a couple of years as well. And forward, now we know that we have that sort of infrastructure ready, so quite naturally and in quite an automated way, our inventory, once we beyond this level of top line, our inventory days would naturally fall even lower.
Got it, sir. And sir, on the overall working capital days, the intention you shared is to bring it down to 90 days, while currently it is quite high. So how do we plan to do that? And if I compare this number with the industry leader, the industry leaders themselves operate at 100 to 140 odd crores of working capital days. So how are we planning to reduce it, especially when we are in a high growth phase and with 3 different verticals?
So, for this, firstly, I mean, when we talk about our inventory days, we actually bifurcate between, let's say, inventory and the other 2 aspects, which are receivables and payables. Now, for inventory, we know that as we keep on scaling, our inventory days would definitely come down, and we believe that that is something once we scale naturally, the inventory side of things that would start losing a sort of impact in context of days. If I talk about receivables, then for receivables, what we are strategically doing is that now that we are started building a good sort of dealer relationship and also the sort of brand response which we are getting from the market, quite naturally in the past couple of years, we have witnessed that when we started with, let's say, sort of over credit periods, now that we have our brand build up, we are able to optimize our receivable days and receivable days as well. So this is something which again is another factor which will help us contribute in bringing down our receivable days. And then on the payable front, currently our payable days they stand at 50, and we believe that 50 or 60 days would be the sort of levels which we would be able to attain. And coming to the point, like the day, how are we expecting it to bring down to 90? So when we talk about, when we combine it on a blended level with our Dubai, or let's say our export operations as well, we believe that the sort of cycle which we are witnessing, this is something which might not replicate to that extent in with our Dubai operations. I mean, from day one, where our legacy inventory was happening in India, that sort of that intensity of investment might not be visible in Dubai, and the sort of growth based on the market which we are studying currently in Dubai. We expect that once our those operations they scale up, and given the intensity with inventory won't be growing, we would see that on a blended level, our inventory days would definitely fall. And when you compare it with our peers, then again, I mean, way they are doing their business, I can't add much on that, but at least what I can comment upon there is that for the major difference would be like for them, exports might not be the most aggressive area, but for us, export market is something where we want to grow as bigger as, and that's where on blended level we would be able to bring down our inventory. And again, this is something which is our core objective, and if things fall as per our plans, we'll definitely able to reach the levels which we are currently envisioning.
Okay. So one more question on your EV tools business. So, two parts to it. First, you mentioned that you are one of the first ones or the pioneers in India to bring EV toolkits. So, if you could share out of the 150 odd crores that we have done this year, how much was the contribution from this EV toolkit? And secondly, you also touched upon a association or some tie-up with a German player who will be helping you out in scaling up this business and some technical know-how. So if you could just elaborate a little bit more on this technical tie-up, what exactly are we gonna do with this company and how will they help us? So that would be really helpful, sir.
Yeah, I would like Mr. Neers to take this answer.
Yeah. I will take it up. See, the year that has just now passed out, you can say about, if I've not gone through exactly, but 12 to 16 crores would have been the revenue generation at this particular segment in the year that we have just now passed. And for the year to come, the current year what we are in, I think that even only Maruti and these 2-3 companies which we have come up with new agreement, they will give us a sales of not less than 15 to 20 crores along with the increasing sales in our regular routine. So that would definitely be amounting to 30 to 35 crores in the current year. And one thing you were asking about or trying to state about that we had come up with a alliance with a Germany company. No. It is nothing like that. There is a VDE certification which is given and which is based only in Germany. The VDE people are in Germany only. We have already taken one or two certificates from them last year, as we are quite an old player in VDE. From the past 7-8 years we are doing it. So we had taken only 1 or 2 certificates from them, but this year we are applying for more than 30 certificates with more than say about 800 SKUs covered in that, those certifications and all. Because once we have those certifications, then anywhere in India, as nobody else is having those certifications as of now, so we would definitely be the first one to have it, and it has a very big cost of taking those certifications. And so till the time one is very much sure of selling that much quantity in a year, no one would be going for a certification which is having a good cost for each and every certificate, which is valid only for 12 months. So we need to take out the certification amount also along with the profits, and we are quite sure, 100% sure of what we are doing and the way we are heading. So that is means a sort of excellent opportunity that we are already having with us.
Okay. So, you mean to say it's a certification that we have got. So, and annually, what would be the expense out of this certification, sir?
Somewhat around, you can say, if not less, 80 lakhs to 1 crore.
80 lakhs to 1 crore. Okay.
Yeah, but again, if you go into the profitization of this particular product, it is from 40% to 400%. It is very much profitable.
I didn't get that. 40% to 400%, sorry?
The profitability in these items, which are more sellable at a minimum margin is 40%, and which are less sellable and you need to keep stocks, it comes around 400% also.
Okay, got it, sir.
So we can easily pay the amount. So we can easily pay the amount for the VD. But again, I'm coming back to my answer which I gave you just now, that you need to have sales in that area of that period of 12 months, because after 12 months, you need to have the certification again from them.
Understood, sir. That's helpful, sir. Thank you.
Yeah, that is very much helpful, and we are already on the approved list of most of the companies in India, maybe say more than 200 or 250, the top-notch companies with the maximum purchase limits and all for these particular item. And we are approved everywhere through directly or through a dealer or distributor. We are already there on list. Any tenders you go through, you randomly go through the EV tenders. After the call, you will see my brand would definitely be there. The first one out of the one they are asking for.
Got it, sir. That's helpful, sir. Thank you.
Yeah. Thank you.
Thank you. Our next question comes from the line of Majid Ahmad with Pinpoint X Capital. Please go ahead.
Thank you, sir, for the opportunity. I'm audible, sir?
Yeah, can you be a bit louder?
Yes, sir. Maybe you should use your handset, please.
Sure. I'm audible now?
Yeah.
Yes, sir. Please.
Yes, sir. So the very good set of numbers. So for my first question, registers, as we are looking for a 25% growth in revenue, I just want to understand of that 25% revenue growth, how much is going to come from price increase or from volume growth? I just need to understand what is going to be the volume or the price growth.
Can you repeat the question? I did not get it. You are not.
Sorry to interrupt you.
Okay, sir. I'll repeat again, sir.
No, I got it. Kanav, I will answer.
Yeah.
See, we are not focusing not even 1% on the price increase for gaining that much margins. The only thing is that our prices are already low, and we are already making those margins out of the price which we have already kept in the market at this moment. We are absolutely focusing on escalating the sales, and the sales escalation would definitely increase the profits. As the numbers will increase, the profit will increase. And if we will come for a price increase, then the profit margins, the percentage of earnings of the company will definitely go up. But for that, I think we will wait for a year or two. Only after that, we will be going for a, say, you can say, monopolistic sort of a takeover of the market once we have a good grip in the market.
Okay. That's helpful. And secondly, sir, as we are talking much on EV part, but I think can you give me some sort of breakup of your product segment mix, like the key product segment mix? It will be helpful.
Means you need to know the what sort of is the EV are being more sold and what are less sold, or what else you want to know?
Sir, I just want on EV part, that's first part. And secondly, on overall consolidated revenue basis, I just want to know what type of product breakup in terms of at least the top 5 products. So for example, if you are selling some screws or something or some spanner, like is there how much percentage of sales it could be, 10% or 3%?
That is very difficult to tell, because even in EV also there are more than 2,000 products. So we have not taken it out product wise. That is not possible. In product wise to the total sales, very difficult, because product wise to the total sales, it's a very big data to be taken out and be comparing about it. Not ready with me at this moment.
And finally, sir, so as you are looking for, especially looking for profitability growth, I think there is a possibility of operating leverage, considering you're looking for higher growth.
Operating? You're not very clear. I think your voice is not so very much clear.
Am I clear now, sir? Am I audible now, sir?
Yes,
sir,
better.
may I request, in case you're using a Bluetooth headset, to switch to your handset, sir?
Sir, am I audible now, sir?
Not clear, sir.
Better, yes.
Okay, sir. So what I'm asking you, sir, is as we are looking for a higher growth in sales as well as we're saying higher numbers, absolute numbers in profit, I just want to understand the cost breakup. How much of them is fixed cost and how much of them variable cost? So that is there possibility of operating leverage playing out as you are looking for higher growth in those markets?
Kanav, Mr. Vijay will take this.
Yeah. Am I audible? Yes.
Yes, sir.
Yes.
Please go ahead.
Yes. So, correct me. So, you largely want to know about our margin computation and what constitutes our gross margin, how much constitutes our fixed expenses where we attain sort of leverage.
Yes, yes.
Okay. Yeah. So, to answer this, currently, as of now, our gross are somewhere around 28%. And if I talk about our fixed costs, they are currently at, for financial year 25, they stand at including finance and other operating costs. So those are around 6 to 8% of my top line. So given the nature of these expenses, like for us, our raw material, or I would say our stock, this forms the major portion of our cost. So yes, this the value which is currently out 6 to 8% of our top line. This is something which would naturally give us a fixed leverage sort of benefit going forward. And as we scale up our revenue, even if we don't increase our, let's say, price list that much, you will still naturally see an increment in our EBITDA margins purely on account of leverage.
Okay. So what you're saying is majorly it is the cost of the product. Your gross margin is coming around 28%, and after that you're saying me 6 to 8% is the fixed component. As you scale, that can. Am I clear, sir?
Yes. Sorry, your voice is breaking a bit, but I think it's like 28% is gross margin. Somewhere around 6 to 8% are my fixed expenses on my given top line of 145 CR, and that's where I get my EBITDA of close to 20%. And this is something, these 6 to 8% of my expenses, to be precise, this is something which would be largely fixed in nature, and that's where I can fixed leverage benefits as well as my revenue scale, even if I don't increase my prices.
Got it, sir. Thank you so much, sir. All the very best, sir. All the very best for coming here. Thank you.
Thank you. Our next question comes from the line of Sahil Raj from Samdariya Capital Ventures. Please go ahead.
Yes, sir. Am I audible?
Yes. So maybe request you to use your handset, please.
Am I audible?
No, sir, you're not audible, sir.
Hello.
Yes, sir, this is better. Please go ahead, sir.
Sir, I wanted to ask, in between FY24 and FY25, we increased the number of OEMs we catered to, but the number of dealers didn't show a significant increase in that comparison. So could you please give some insights on that?
Yes. So, as we told you, see, like in a big city like Delhi, I will be telling you our model, how we make dealers and distributors. In a big city like Delhi, we have close to 4 or 5 dealers/distributors. In a small city like Bhiwadi, we have just one dealer who can cater up to that small city. So increasing the number of dealers until we penetrate deep into tier 2, 3 cities, it is not easy and it is not advisable. As if I make one more dealer after 5 dealers in Delhi, if I make the 6th dealer, the earlier 5 will get disrupted because the total sale is not increasing. It will get divided by, which is getting divided by 5, it will get divided by 6 dealers. Increasing the dealers is not the only parameter which we have in mind. And parallelly, when we talk about OEMs, we did not focus for many years. We opened up this new avenue. So in the coming years, you will always see more OEMs coming up and more OEMs adding up than more dealers again. For that particular reason, we have almost covered whole of India. There is still scope of making dealers in India in tier 2, tier 3 cities. Majorly all the cities we have covered, which we will make in this year. But to have possibility of making more dealers, we took this decision of going to UAE to open up a whole new geographical space for us. They again have 7 Emirates to make dealers. I am planning to make about 15 dealers in UAE. So here the geographically there is some level of exhaustion in India which I wish to get from the UAE in the couple of few coming years. So in the next 3 years we will focus on increasing our OEM, because as number you will always see OEMs at least in the next 3 years increasing more far numbers than the dealers.
All right, sir. Another question is that for FY26, do we have any internal targets that this number of revenue is from dealers, this is from OEMs, and this is from the Dubai operations? Any segregation on that?
See, Dubai operations have just started, but yes, to start with, we should cross 8 to 10 crores in sale in absolute numbers in Dubai. And for the part, as Mr. Neers told this call earlier, we are expecting about 15 crores of sale alone from Maruti and Hyundai combined. And with the dealer, majority of our, more than 90% of our sale from this 145 crores is from dealers. So you can easily 25-30% increase in that. So that is about it.
Okay, sir. And any slowdown we are seeing because of the automotive slowdown that we saw in Q4, where the sales were not that good for all the automotive companies. Is that affecting our business in some way?
Automotive is a very, very big client of us, but there is no as such slowdown because their demand is much, much, much bigger than what we can supply. So according to us, there was no slowdown. We are, and the Maruti came after that, and it has been very good since then. We have already on the front supplied so many kits to them already. So we don't think there is a slowdown. When a company like Maruti comes in or Hyundai comes in, so for a player like us, it is always growing. Even if their total number slows down, it is big enough a market for us.
Just to add up, I would say that hand tools are required to maintain the vehicles, right? And so we are not basically dependent upon the new vehicles to be sold. We are always there to repair the old vehicles, which are quite a lot in number already. Every year, sale are getting piled up upon the older ones, and our tools are required for the older ones only to be opened up, the machines and everything, the engines and all. So our tools are required to work on the already existing vehicles, not on the new vehicles. New vehicles don't need anything for at least 8 to 16 months or 15 months, something like that.
All right. Sir, any insights on our current working capital limits? Do we have sufficient enough for the current year and going ahead, or do we need any funds separate from that?
As of now, what we have planned, so it should be enough for us. We are not short of that as of now, because we are moving towards efficiency only. So as of now, we are not facing any issue there.
All right, sir. And one final request, maybe if the team has any discussions on that. Are we looking for quarterly updates going into FY26? Any plans on that? One page or summary or some sort of that?
We are definitely planning a business update like we did in the December quarter before this. So though we are an SME company and it does not apply to us, but we are definitely trying to give a quarterly business update that we can give, not audited results, but yes, a business update for sure.
All right, sir. That's very good. Thank you. All the best.
Thank you.
Thank you. Our next question comes from the line of Pranjal from Niveda. Please go ahead.
Hi, sir. As you mentioned in the beginning that you are the third biggest company in the sector, I would like to know what your competitors are and what differently they are doing that you are not doing, and what kind of vision do you have for the company?
I would like Mr. Neers to answer this.
Yes. So you want to know that how the competitors are better than us? That is the main thing.
Who are the competitors, how they are better, and what is the vision?
The definition of better is very difficult to answer because I would always say that I am the best, right? So, and I'm actually is the best. I'm the best, I would say. But the thing is that they are the number one company in hand tools is about say 54 years old, as per my knowledge. And the number two company is also about 30 years to be completed from their existence. So the only thing is, in India, when the companies become old and when they keep on, when the people keep on hearing the names, okay, we use this product, we use this product. So then the demand and then the people, then the distributors, the dealers all over India buy those products which the customers are asking for again and again. So the only thing about these two companies are that they are still there from the past 30 years and from the past 54 years. That is the only thing. And definitely they give a good quality.
You mean to say they have made the brand bigger in those years?
You mean to say they are definitely, when you're there for so many years and people keep on buying your product only, definitely there will be growth in all the aspects, like the demand will increase, the profitability will increase, the revenue will go up, your fame will go up, everything will go up definitely. But you need to be there amidst all the ups and downs in the market, in the government, in the country. You need to go up. That's it.
Got it. Oh, so would you name those competitors?
Yes. Number one is Tapadia and number two is Osho Tools, Ludhiana. One is Tapadia, Nasik.
Okay. And so are there margin profiles? Do you have any clear idea about the margin profiles and everything? Are they similar to yours?
I don't think so. They are much better than me. Much better than me. I would say that I can come up to the same margins, and that would be definitely a triple or 4 times better reports by my company at that time. But it will take 4-5 years, and means definitely by that time, I myself as a company is trying to become number 2 or maybe number 1 in the next 6 years. That is my 100% guarantee to you all.
Okay. And what top line would be there in the next 6 years? If you had to guess.
God knows. I would say because this all depends upon the 6 years is a pretty long time to say, but I can say that in 3 years we can move at least 80% forward than what we are now. At least.
Got it.
Mr. Francis, does that answer your question?
Yeah. And so if you can give me your industry-wise revenue breakup.
I mean to say, I don't get it. What industry-wise?
Revenue breakup. From which industries do you get how much of revenue? Is your most revenue coming from automobile sector?
No. That is very difficult thing to answer, because you see, we sell a particular product. It can be put to use to thousands of places, like means thousands of places. So it is very difficult to say. But if you would like to know my personal this thing, then I would say from industry it would be 45%. From automobile and mechanics, it would be 20%. From OEMs, and again 15%. And the rest, you would say this one, what we were talking of. The one you were asking about, that one.
I'll just add to that why we are not very confident of the end user is that we don't sell to everyone directly. What sales we are making, the dealer is demanding that from us, and they are licensing and they are fulfilling the requirements of the industry. So this is our basic knowledge, or we can give you a vague idea of where they are going. To name a few industries where our material goes is number 1, automotive, construction, textile, healthcare. These are a few industries amongst so many which use our product. But to give a bifurcation, I am not selling to them directly. We are selling to dealers, dealers are selling to them. So it is difficult to bifurcate, and we cannot ask the dealers who is your end client. They might not like to share it with us.
ओके ओके गॉट इट। और सर मेरा एक लास्ट क्वेश्चन था। सर जैसे कि आपने बोला आप ज्यादा करके डीलर एंड डिस्ट्रीब्यूटर के साथ व्यवहार करते हैं, तो आपको अगर मुझे समझाना रहेगा ये कैसा होता है, लाइक आप कैसे डीलर अक्वायर करते हैं या डिस्ट्रीब्यूशन नेटवर्क कैसे वर्क करता है ये पर्टिकुलर सेक्टर में, तो प्लीज आप उस पर कुछ इलैबोरेट कर सकते हो क्या?
Mr. Neeraj, please. See, we are having about 16 means self-employed people, executives who cover the complete pan India, and for different areas we have put up different people. And when we get inquiries, because this was a process that was started so many years back, but now you're asking me to just sum it up. I'm doing that for you. So whenever there is to be some demand from particular area, we used to send our person to visit to that shop or that distributor who was interested in buying from us in bulk. And over the years, we have been able to make few dealers and few distributors, which are very good all over India. But few areas in India are still not very much being penetrated. What I feel like Kerala is not so much penetrated, and the eastern side, because quite a few areas are still left out because we were quite busy in the northern region, in the southern region of India, of making ourselves more popular. Now we are moving towards the other part of India, and in the next 2 years, as we are going to increase our sales by 60 to 80%, so we will definitely be covering the most of India, and that would easily be making us improve our sales by 60 to 80% only by adding up these new dealers and distributors.
Question: what is the price difference between your products and the other two players' products?
That ranges from, see, the quality comes into question into this answer of yours, what you are asking, the question of yours. So, if we talk about the number one leader in India, then I would say that my quality is either equal to him, or I would say as for myself that it is better than them, right? And their prices are 25% to 45% higher than me. I'm selling the same product of a better weight, of a better standard, but their prices are 25% higher than me, 30%, 35, 40, 45% higher for the same product. And if we talk about the second manufacturer, the only thing, the advantage that he is having is that as I have SKUs about 7,800 as on date, he is selling only 1,200 SKUs. That's it. And out of those 1,200, he is mostly into selling only 400 to 500 of them. And those also at a very competitive price, competitive to the prices of mine. But he is not having the sales for all the SKUs because he is not selling those SKUs. And we are the only one in India which are having, means I think more than 4,000 SKUs would be there with only Neers, not with any one of these two top people at this moment. And what I was trying to tell in the conversation today, that you wait for only 3 to 6 years, and I think we can come up to number 2 in 3 years. And for coming to be on the number 1, I would not be taking more than 6 years. And my deadline is 8 years. You can note it down. You can tape it, do it, anything. I will be on the top within 8 years from now. By 2033, I would be the number 1 hand tool industry, the company of the hand tool industry in India.
Got it, sir. Thank you so much. That's a great vision. Congrats.
Yeah.
Thank you. Our next question comes from the line of Keshav Kumar from Raksan Investors. Please go ahead.
Hi, sir. Thanks for taking my follow-up. Sir, to an earlier participant, we mentioned that the investment intensity in Dubai will not be at the similar pace as it was in our legacy Indian business. So why will that be so?
So I'll answer this question. In India, we have maintained the stock of the such a big range of SKUs. So when Dubai requires it, see, whenever we want to get a product made from the factory, they make minimum 7 tons of that. There is an MOQ associated with that. So even if I am able to sell that product in 4 months in India, I will have to buy that. Or even if I know I am able to sell that product in 8 months in India, I will have to buy that. Now what I have done in India, I have accumulated all the stocks and complete all the MOQs that I needed to get that particular product made. Now when a similar demand comes in Dubai, I can feed that warehouse from my India warehouse. I don't need to fulfill that MOQ again. So if my Dubai subsidiary needs 400 pieces, I need not make 80,000 pieces of that. I already have 80,000 pieces of that in my India warehouse. I can easily supply 400 or 800 from India to Dubai. So that kind of robust capex, or you can say stock, is not needed again or does not need to be replicated again in Dubai. As the shipping time from India to Dubai is not very huge, it is approximately 12 days. So the kind of products we are doing, we are into very niche products which not many other brands are doing, or maybe we are the only ones doing that. So our customer waits for that kind of time, and we can maybe supply some from Dubai, and then we can feed the rest from India to our Dubai warehouse. So we don't need to replicate that kind of big inventory there.
Very clear, sir. And sir, you also mentioned that the UAE market is bigger than India. So I'm trying to wrap my head around how that is so. Is it the local demand or demand that comes from exporting to EU and then Indian geographies?
It would be wrong to say that the demand is bigger than India, but I can say the opportunity is definitely bigger than India. When I sit in Dubai, I can easily cater to the UAE, which is in the plans right now, which we are currently doing. The 7 Emirates we can cover by road easily. We are located centrally. We can easily cover 7 Emirates. So this is to start with. Once you cover the UAE, then there are OEMs in the UAE itself. Abu Dhabi is very rich in refineries. Our big refineries, ENOC, ADNOC, which is the Abu Dhabi National Oil Company, they are huge. Here we are supplying to Indian Oil and other refineries of petroleum companies, but ones in Abu Dhabi are much bigger than what we have in India. So getting approved from them, it is a very big opportunity for us. Secondly, once we are settled there, Gulf, GCC we can cover, the what you call the whole MENA region. Africa is a big importer of hand tools from Dubai, from UAE. There is a market called Dera in the Bania Square. There, the movement of African buyers is very high. This kind of opportunity I can never get in India. So opportunity-wise, it is a very big market for me to be seated there, to be available there. The presence itself can open very big opportunity doors for me in the coming years.
So, sir, then who are we competing with in that geography?
Sorry, but your audio is not coming in clear, sir. Can you please use your handset?
Yeah, is it clear now?
Slightly, there's slight static, but it's okay, sir.
Okay, so on the competition front, when we talk about the Dubai subsidiary, so whatever competition we have locally over there, whatever is getting imported, and in the geography we aspire to sell to also. How is the market structured?
See, Dubai initially we all know was only a desert when it's profit trade. They are majorly importing everything. They don't have big industries except for the refineries and Abu Dhabi. They are majorly importing everything. So coming back to the point, the competition is from all the big global players, from the Germany players, maybe the top 5 in the biggest players in the world are available there. But where we win is we are very, very price effective, cost effective when we compare ourselves to the German brand makers. They are even 20x of what we are selling. So there is always two sides of the story. Maybe where they are already approved, they will keep giving, but there is a very big chunk, especially in the American market, which I was talking about, which will be procuring our goods mainly because of the price point and right quality at the right price. Competition is always there from the global players. Many of the global players are available there. Some of the Chinese players are available there. But hand tool is, especially talking about if we break it down into two parts. One is intensive and one is labor intensive. So when it comes to the labor intensive hand tools, the spanners, the screwdrivers, the pliers, which are labor intensive, which even a small or a moderate family factory setup would need about 300 to 400 employees. No one can beat the labor intensive product hand tools in the world. So the Chinese are expensive than us in the labor intensive products. And our core range or a big range comes from the labor intensive products which are made in Jalandhar, which are made in Punjab, and which require too many working employees. The labor, you can say, because the labor cost is cheaper in India as compared to even China. So the price effectiveness in UAE is one of the winning points for us, that the quality is there and the prices are good with the right kind of quality they need.
Very, very clear, sir. Sir, on the automotive tools business, who are we? Are we competing same players, or is it a differently structured market there?
Sorry, your voice is not very clear. Can you repeat?
The auto OEM business, are we competing there with the same two competitors we mentioned in the past?
The same two competitors are not available there, or they are just exporting in a very, very, very small way. They don't have a proper robust setup there like we do. So the top two people, I don't think will be any competition to us there. There will be other global competitors, but not these two.
Okay, sir. Sir, one last question. So the OEM business, will it have better margins than what we've done for the full years? And do we have to offer a longer credit period to customers in comparison to other branded sales?
OEM segment would attract us minimum 5 to 10% more gross margins than our current legacy dealer business. And the advantage of working with OEMs is that they get a particular, let's say, take example of Maruti. They just got one kit, which is approximately of a big cost. So we finalized about 70 to 72 pieces in one kit. So that is the only thing they need the whole year. So my optimization, the stock keeping, everything improves, efficiency improves. When you deal with a dealer, they can ask for anything out of such thousands of SKUs which we have. But when you deal with an OEM, it is already prefixed, preset. So you always get better margins. And some products we are taking locally and some we are importing. So we also have a better say to the vendor we are buying, because quantity of one product is more in case of OEM. So we have a better bargain when we buy those products also. So everything increases, margins increases.
Understood, sir. Thanks a lot, sir, for all the answers. And all the best for the quarter. Thanks.
Thank you.
Thank you. Our next question comes from the line of Ankur Gulati with Genuity Capital. Please go ahead. Mr. Ankur, may we request you to unmute your line, please?
Hello?
Yes, sir. May we request you to use your handset and go ahead with your question?
Hello?
Mr. Ankur, may we request you to unmute your line from your side, please?
Am I audible now?
Yes, sir. Please go ahead.
फाइनल ईयर 2025 में अपना OEM का सेल्स कितना था?
Must be around 4% of the total.
सॉरी, थोड़ा सा वॉइस ब्रेक हुआ क्या? नंबर अगेन प्लीज.
Must be around 4% of the total sales.
अच्छा. और ये H2
Sorry?
Sorry to
second
interrupt,
half of
Mr.
the year.
Ankur, sir, your line is not clear, sir.
Okay, I'll join back. I'll join
Thank you,
back.
sir. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
So thank you everyone for your time today, and we always invite questions on our mails. If any query you want to connect to the management team, we are always there, and we always welcome your questions to us, if any. So we hope to get the best of the results this year again. I would like to just make a closing remark. As financial year 25 performance demonstrates that Neers is not just maintaining its market position, but actively expanding its footprint both domestically and internationally. With a robust financial metrics, strategic initiatives, and clear vision for the future, we are confident in delivering sustained value to all our stakeholders. Thank you for your continued trust and support. Thank you, everyone. Thank you so much.
Thank you. Thank you, sir. On behalf of Share India Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.